Hello and welcome to the new video. In this video I'll be discussing about a different trading strategy, which is spread. So what is a spread? Spread is a trading strategy which involves buying and selling of either calls or puts. So how can we make spreads? Well, we can make a spread by buying a call and selling a call, or equivalently buying a put and selling a put. That means spread involves only calls or only puts. So why and how? Why should we add up spread and how it works? Let's see. So let's say we believe that the stock price is going to be increased in future. We made some analysis. We analyzed some factors, volatility, elasticity of the stocks, and some other factors. So we believe the market is going to be go up and the stock price is going to be increased. So in this belief, we can add up two sets of strategies. Strategy 1, we enter a long forward contract. That means we are entering an agreement that we will buy the stock in future time t at the prefixed price. That means we are fixing the price today, irrespective of the price goes up or down. So it doesn't matter what will be the price at the expiration, we will buy the stock. So when we made this agreement, we spend nothing, so initial expense 0, and the payoff at the maturity is ST negative K, where ST is the spot price and K is the forward price. So if the forward price is 100 and the spot price at maturity is 110, then our payoff will be $10 according to the formula. However, if the spot price at maturity is $90, then we will make a loss of $10. Why? Because we're buying a stock which is actually priced at 90, but we're buying at $100 because 100 is the promised price. And the other part of the strategy, we buy a call option where the strike price is same as the forward price, that is K. So initial expense here, the initial expense is not 0 because we are buying call. That means we must pay the price of the call, or we pay the premium of the call, and at the maturity the payoff is defined by this formula maximum of ST negative K or 0. So we can see that the payoff from a call option can never be equal to 0. It can never be any negative value. So it either 0 or higher than 0. So let's give a mathematical example. We buy a call option for $5. So if the forward price, that is the strike price, is 100 and the spot price at maturity of the stock is 110, then according to that formula our payoff will be maximum of ST negative K, that means 110 negative 100 or 0. This gives us $10. And if the spot price at maturity is $90, then we do not exercise the call option because spot price is 90 and our strike price is 100, so we don't need to exercise it. Call option gives you the right to buy a stock at your strike price when the spot price is above your strike price. So you will be benefited when the spot price goes up than the strike price. So in this case we do not exercise it. So what is the summary of strategy 1? If the price goes up, payoff from the forward plus payoff from the call negative all expenses, that is $14. And if the price goes down, the payoff is negative 16. That is not payoff, actually profit. So we can see when spot price goes up, we make $14 profit, and when price goes down, we make a loss of negative $16. So let's consider a different strategy. Here we buy a call option with a strike price 100 for $5, same as before, and for the other part of the strategy, instead of entering a long forward contract, we sell a 105 strike call for $4. Maturity is the same for both options. So initially we spent $5 for buying 100 strike call, and we received $4 for selling out 105 strike call. So our total expense -$1. So if the price goes up, same as before, say 110, then payoff from the bought call option according to that formula, maximum ST-K is $10. However, the sold payoff from the sold call option, it's the same, just additional negative sign because we sold it. That's the opposite. So here in this case, K is 105 and our payoff is -5. That means we made a loss of $5. So the total payoff 10 - 5 is $5. Profit 5 minus accumulated value of 1. This accumulated value is our initial expense and some interest on it. Let's say during this period it's 1.15 including all interest. So the total profit is $3.85. So what if the price goes down? Let's say it's $90. The payoff from the bought call option again is 0 because we do not exercise it, and payoff from the sold call option, it's also 0 because the buyer of this call option doesn't exercise it. So total payoff 0, and profit is just the accumulation of our initial expense is -1.15. So the summary of strategy 2: price goes up, profit 3.85, and price goes down, it's a loss of 1.15. So which strategy is better, strategy 1 or strategy 2? Let's see. Strategy 1, price goes up, profit 14, and price goes down, loss of 16. Strategy 2, price goes up, profit 3.85, but when price goes down, we made a loss of 1.15. So which strategy is better than what? Which one? So if you are a risk averse investor, then you should choose strategy 2 because it gives you less profit but also less loss. But if you are a risky investor, then you should choose strategy 1, which gives you a great profit when the spot price goes up, but it also kills you when the price goes down. So if you are a risk averse investor and you want to be efficient in trading, then you should choose strategy 2, which actually spread. In this case, it specifically said it is a bull spread because we bought a lower strike call and sold a higher strike call. So let's discuss different types of spreads. First, bull spread. We did it already. We buying a low strike call and selling a high strike call, which is bull spread. Equivalently, we can make a bull spread using put options. So buying a low strike put and selling a higher strike put. All is when we want to make a bull spread, we have to buy lower strike and sell higher strike, only calls or only puts. That's the bull spread. So what is bear spread? Bear spread is just the opposite of a bull spread. In this case, we will buy higher strike call and sell lower strike call, or we will buy higher strike put and sell a lower strike put. What's the next type? It is box spread. Box spread is a spread which always gives you a positive cash flow. So it's better. It is for the most risk averse investors. So how we can make a box spread? Box spread can be made by buying a long synthetic forward and selling a long synthetic forward of different strike, and with, in short, buying a lower strike call and sell a put of the same strike and sell a higher strike call and buy a put of the same higher strike. It seems very complicated and confusing, but it's not actually. We will be clear when we do these strategies using Excel. So what's the next type? The next type is ratio spread. Ratio means ratio up to different strike of same options. So buying M options at one strike and selling N options of same type at different strike. Both cases the maturity date is same, so that the initial expense is approximately 0, not equal to 0, but if it is equal to 0, that's good. So mathematically we find the ratio by this formula, where C1 and C2 are the option prices of two calls. So if M over N equals to 0.5, that means if we buy 10 calls at one strike, we have to sell 20 calls of a different strike to make a box split, which will always give you a positive cash flow at the maturity. So the strike price, we consider this scenario, we will consider three strike prices, 35 to 45 of different different calls and different puts. And here we need further assumptions. Black-Scholes option price, Black-Scholes option price is assuming a stock price $40, that means the current price is 40, volatility of the market is 30%, effective annual risk-free rate is 8.33%, which is equivalently 8% continuously compounded, and dividend yield 0, that means these options don't pay you any dividend, and 91 days to expiration, that means time t equals to 91 days. Let's make all the strategies that we discussed in using Excel. So in Excel, so for a bull spread, what bull spread says? It says buying a low strike call and sell a higher strike call. This is a call option. So we choose 40 and 45 two strike prices. For a 40 strike call, the price is 2.78, and 45 strike call, the price is 0.97. Let's see how we can make it. We bought a 40 strike call, so our payoff should be, since we bought, it's positive and it's call, so maximum of ST, this is our ST, negative the strike price, which is 40, or 0. That's the payoff from buying 140 strike call. Let's find the payoff for written 145 strike call. Since we wrote it, so first negative sign, then maximum of, since it's call option, again the same formula, ST negative K. What is K here? K is 45, right? So 0. So that's our payoff. So total payoff can be found by adding these two payoffs. Now let's find total expense. Total expense, since we bought a 40 strike call, this is our 40 strike call price, let's fix it. And since we sold or wrote 45 strike call, this is positive, and bracket close, times 1 plus, this is our interest rate, fix it, to the power time 91 days, or equivalently 0.24932 years. I also fix it. So this is my total expense. So the profit is total expense plus total payoff. That's it. So let's see how the graph changes. That's the graph for bull spread. Select data, edit this column, this row. Well, this is our bull spread for call options. Similarly, we can make bull spread using puts. So this is my sell. We can make it here. So if we want to make a bull spread using put, then we will buy a low strike put and sell higher strike put. Just the same thing as we did here using call, we will do the same thing using puts. So we bought 140 strike put. So our payoff should be maximum of, in this case it's the opposite. So strike price minus spot price. Here strike price is 40, negative spot price 20, or 0. And when we wrote a call or put option, always it's negative maximum of strike price, negative spot price, or 0. The total payoff is addition of these two payoffs, and the total expense is, since we bought 40 strike puts, it's negative, and fix it, and we sold 45 strike puts, so it's positive, and then times 1 plus interest to the power times so net profit is this is our net profit. If we want to graph it, you can see we have the same type of graph for bull spread using put options. If we want to compare, we can see we get the same type of graph. So that's the bull spread. So for the bull spread, we can see if the price increases unboundedly, infinitely, our profit is limited, and similarly if the price decreases, in this case our losses are also limited. Let's make bear spread. What is bear spread? Buying as we said earlier, bear spread is just opposite of the bull spread, buying a high strike call and selling a lower strike call. So we bought 145 strike call and written 140 strike calls. So the payoff should be maximum of spot price negative strike price. Strike price is 40, negative or 0. That's the payoff. And for writing a 40 strike call, always negative before maximum, since it's call, so spot price negative strike price, it's 40 here, or 0. So total payoff can be found by adding these two payoffs, and total expense can be found, since we bought 45 strike call, this is our 45 strike call, negative 45 strike call, fix it, and sold 40 strike call, this is our 40 strike call, fix it, and then times 1 plus interest rate to the power time. So that's our total expense. Now net profit, total expense minus total payoff, that's our total profit, net profit. So if we want to see how it says using graph, we get this graph, select data, edit this row, so that's it. So as we said, bull spread and bear spreads are opposite, so we can see from the graph. So it's opposite. So we can also make bear spread using put options, but I won't do it here. But you can do it in your home. So let's make box spread. This is kind of complicated, so we make it. Let's see how it works. So buy a lower strike call and sell a put of same strike. So we bought 140 strike call and write 140 strike put, and then sell a higher strike call and buy a put of the same higher strike. So we wrote 45 strike call and we bought 45 strike put. That's how box spread works. Let's see whether it gives us a positive cash flow or not. So the payoff from buying 140 strike call is maximum of spot price negative the strike price 40 or 0. So and then written 40 strike put, since it's written negative before and maximum since it's put, so strike price negative the spot price or 0. That's the payoff. Now for written 145 call, since it's written negative maximum since it's call, so spot price negative the strike price 45 or 0. And for buying 145 put, so since we bought it's positive maximum of, since it's a put, so strike price negative the spot price or 0. That's it. So to calculate the total payoff, we just add these 4 payoffs. So payoff is always same in either case. The price goes up or down, whatever the total expense. Total expense, we bought 40 strike call. This is the price for a 40 strike call. Since we bought, it's negative, and then we wrote 140 strike put. This is 40 strike put, and again we wrote 45 strike call. That's the price for a 45 strike call. Price for a 45 strike call, and again we bought 45 strike put. That's why it's negative times 1 plus the interest rate to the power times t. See, so that's our total expense. So let's calculate net profit. Total expense subtract total payoff. That's it. So we can see we always observe a positive cash flow, although it's very small amount, but you will never lose any money if you just use the box spread strategy. Now let's calculate the ratio spread. So the ratio spread says buying M options at 1 strike price and selling N options of same type at different strike, so that the initial expense is 0 or approximately 0. So let's say we choose 40 and 45 strike for call options. We'll make the ratio spread for call options. So using this equation here, we get M over N equals to 0.35, which is approximately equal to 7 over 20. So it says that if we buy 740 strike calls, then we have to write 45 strike calls in order to make a box spread. In order to make ratio spread. let's calculate the payoffs. Since we bought 7, put 7 first, then maximum of spot price negative the strike price 40 or 0. That's the payoff. And for written 20 45 strike calls, since we wrote it's negative times maximum of spot price negative strike price or 0. So total payoff is found by adding these two payoffs. That's the total payoff. So what about total expense? Total expense can be found since we bought 740 strike calls, so negative 7 times for price of 40 strike calls, fix it, plus 20 times 45 strike calls, since we bought it so it's positive, times 1 plus interest rate earned during this period to the power time. So that's the expense. Therefore the net profit so if we want to grab this, that's the profit curve for ratio split. So I hope everything is clear now. If it's not clear, you can send me a message or email me or make a comment. I'll try to answer this. Thank you for watching.